This could be your last withdrawal. We are getting bombshell report after bombshell report about the banking system, and guess what, people? There's been new major banking downgrades for these next 7 banks, and the reason they've been downgraded is because they could be failing very, very soon. And I don't know if you've been following the bond market lately, but do you know the reason why the banking crisis started in the first place? It was because the bond market crashed. What's been happening lately? Well, we've seen a 10-year crash, we've seen yields skyrocketing, so this is going to mean all these banks that have all these bonds on their balance sheet, well, they've just lost huge amounts of value, and guess what? Now with these recent banking downgrades are happening, a lot of people are going to withdrawing their money, and this is going to cause another banking crisis. So everyone, you definitely need to pay attention, because in today's video, I'm going to reveal the banks that are at most at risk, and if you're banking with one of these, you're definitely going to want to get your money out now. So everyone, let's not waste any time, let's get straight into the news, the facts, and the data. Well, it is official, everyone. Now, don't get this confused with Moody's downgrades. S&P, on top of Moody, has downgraded multiple US banks, citing tough operating conditions. Why don't they just call it for what it is, everyone? We are not under tough conditions. We're in the middle of a financial crisis that they just don't know it yet. And we can see here a lot of these banking stocks are in the red today as well. But okay, what you're all waiting for, what banks are most at risk? Well, look at this, everyone. S&P Global on Monday cut credit ratings and revised its outlook for multiple US banks, following a similar move by Moody's, warning that funding risk and weaker profitability will likely test the sector's credit strength. And what they mean by funding risk is deposits are fleeing. S&P downgraded the ratings of Associated Bancorp and Valley National Bancorp on funding risk and a higher reliance on brokered deposits. But that's not all, everyone. It also downgraded UMB Financial Corp, Commercia Bank, and Key Corp, citing large deposit outflows and prevailing higher interest rates. What's going on, everyone? I thought the banking crisis was over. I thought everyone was putting their money back in the bank and there was no withdrawals happening anymore. Well, turns out that's not the case at all. But okay, what we also need to know is, why is S&P so worried, and why are all these banks getting downgraded? Well, a sharp rise in interest rates is weighing on many US banks' funding and liquidity, S&P said in a summarized note, adding that deposits held by Federal Deposit Insurance Corp, insured banks will continue to decline as long as the Federal Reserve is doing quantitative tightening. That's exactly right, everyone. Even though the Federal Reserve has stopped lifting interest rates, they're still selling bonds. And at the same time, the US government is issuing more bonds. And simple economics, if there's more supply coming onto the market and there's not the demand to meet that extra supply, well, prices simply have to fall. And again, this is very bad for the banks, because a lot of banks have these bonds as collateral on their balance sheet, and they sell these bonds in order to meet their deposit outflows. But if these bond prices crash and they don't have enough cash to fund these outflows of deposits, well, guess what? The bank is going to fail. The ratings agency also downgraded their outlook for S&T Bank and River City Bank to negative from stable on high commercial real estate exposure, among other factors. So everyone, it is happening. We're starting to see the real pain, the real impact from these higher interest rates. The commercial real estate market is tanking, and this is having a big hit on banks, and we are going to see more bank failures from the commercial real estate crash. Now, this is on top of Moody that had earlier this month cut the ratings of 10 banks by 1 notch and placed 6 banking giants, including Bank of New York Mellon and US Bancorp, State Street, and Truist Financial, on review for potential downgrades. So everyone, are you starting to get the picture? We are in the middle of a banking crisis. It is not over. We are in the middle of a financial crisis. I don't know what more proof I can give you, because a lot of people are saying, look, Michael, nothing's happening. You've been warning us all along. Nothing's happening. Well, yes, maybe the world hasn't stopped, but if you look at the financial system, if you look at the financial markets, a lot has happened and a lot has changed. And something that has changed for the bond market, like I've been talking about with bond yields surging, is not just the Federal Reserve. Investors are starting to look at something else that's very, very alarming. Now, again, why we have to pay attention to the bond market is because that will be a catalyst for more bank failures. A recent spike in US bonds has come alongside muted expectations for inflation, a sign to some bond fund managers that economic resilience and high bond supply are now playing a larger role than second-guessing the Federal Reserve. So everyone, what this means is the bond market isn't tanking because of they're worried about inflation getting higher, even though I'm worried about inflation surging again, especially with a recent spike in gas and petrol prices. But again, the reason why the bond market is tanking is because of quantitative tightening, the Federal Reserve selling bonds, and also the US government being so much in debt, they're having to issue trillions of dollars worth of bonds every single year. Now listen to this. This is crucial. The benchmark 10-year nominal yields on Tuesday hit a near 16-year peak on concerns about the US Federal Reserve Chairman Jerome Powell sending a hawkish message about keeping rates high at the annual Jackson Hole symposium on Friday. So do you know where bond yields are right now? Well, they're at the same level as 2007. What happened after 2007? Oh, that's right, a financial crisis, what we're about to be facing very, very soon. But that's not all that's happening, everyone. Investors see evidence that a fresh set of drivers has taken hold, including the Bank of Japan letting yields go higher, which may reduce foreign investors' appetite for treasuries, and an increased supply of US government bonds, with investors demanding more for holding more debt. That's exactly right, everyone. Who is the biggest holder of US treasuries? The Central Bank of Japan. And now with the US government so in debt, with them getting their credit rating downgraded, a lot of people are wanting more interest for the higher risk. And again, everyone, you can see this chart here, the US 10-year real yields rise to GFC levels. So we can see here in 2008, and this is where we are right now. Now, Reuters warn here, while such longer-term factors have become more prominent recently, the Fed's more immediate monetary policy actions could land right back in the driver's seat in case of a re-acceleration of inflation or a sharp deterioration in the economy. But you know what's even more crazy, everyone? Talking about inflation is now considered right wing. Look at this, everyone. This is absolutely hilarious. I just wanted to share this with you. Inflation labeled a right wing talking point in response to hit working class song. I think we all know what that's about. That's Oliver Anthony's song, Rich Men North of Richmond. And this has the politicians absolutely terrified because what do they want to do? They want to divide the country when this song is uniting the country. And I don't know if you see a trend here, everyone, but it seems like everything that goes against the establishment is considered a right-wing extremist conspiracy theory. But I digress, back to the markets. So do you want more proof that there's lots of pain coming for retail, everybody, and the economy? Look at this. Foot Locker Inc., their stock is down a whopping 31%. And why could this be happening? Because what have we been seeing lately, everyone? We've been seeing these viral videos of people just walking in with big, huge garbage bags and loading up, taking anything under $900 and just walking out. Well, it turns out that if you don't actually enforce the laws and, do good police work, this is going to have a devastating effect on these retail companies, and they could completely collapse if something isn't done about it. But I think now that these stocks are losing billions and billions of dollars in value, maybe all of a sudden these politicians might do something. So look at this, everyone. Retail stocks were hit hard Tuesday after disappointing forecasts left investors underwhelmed. Shares of Dick's Sporting Goods fell 24% in trading Tuesday, erasing the stock's previous 22% year-to-date gain and marking its worst day since its IPO. The plunge came after the retailer slashed its earning guidance, blaming retail theft. So we're starting to see the real-world effect on this crazy theft that's going on right now, and the law, these judges doing absolutely nothing about it, and reported a 23% drop in profits. Meanwhile, fellow retailer Macy's dropped 14% despite topping expectations as it stood by its conservative full-year guidance, and CEO Jeff warned that customers will continue to be cautious for the rest of the year, hurting sales. Wednesday didn't look much better as shares of Foot Locker, like we said, fell 26%, now 31% in pre-market trading after the retailer reported falling sales and slashed its outlook for the second time this year. So this is absolutely crazy, everyone. Not only are we facing bank failures, but we're going to see a lot of big box retailers completely exit the market because this theft is so out of control and it's ruining all their profitability. But everyone, I know you're thinking, well, okay, what does all this economic jargon mean for you in simple terms, and how can we prepare and protect ourselves? Well, what this means is, unlike the mainstream media saying the banks are still in big trouble, I still expect we're going to see multiple bank failures by the end of this year, and I also expect we're going to see more pain for retailers, and that's going to be more pain for the stock market as well, because if people stop spending, these companies' revenue is going to drop, like what we're seeing with Foot Locker and all these other retailers like Dick Smith's Sporting Goods and also Macy's, etc. And we're going to see some big pain for stocks in the retail sector. So again, okay, how can we protect ourselves? Well, first things first, don't keep all your money in the bank. That's a very big risk. You want to diversify where your money goes, and also how you can protect yourself against, a recession, caution against a possible stock market crash, especially with retails. Not all stocks will crash. There will be some areas that will outperform, while you can buy gold and silver. Now you may be thinking, well, look, gold and silver hasn't been performing that well, and the reason why is this. So what do I talk about in my course, everyone? I say when the dollar goes up, gold simply goes down, and most other commodities. And we can see here over the past month, the dollar has been rallying, which I think will be short term, or it just means all other fiat currencies are falling at a faster pace. So whenever the dollar goes up, that's short term bearish for gold. But when things really hit the fan, when this financial crisis gets worse, we will see gold and silver skyrocket. But everyone, that's just my thoughts on this situation. What do you think? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.